All right, welcome, welcome. It is September 27th, and we are live with my friend Burney Ashley, return guest. Welcome back, Burney, mortgage broker from Chicagoland, out in that area. Is that right?
Metro Detroit.
Metro Detroit. Okay. Of course, I'm on the East Coast over here in Connecticut, just outside of New York. But mortgages follow everybody everywhere, so we're going to have that mortgage conversation like everybody's having with the Feds cutting rates and what's going on in the market. Just by way of introductions, why don't you tell everybody a little bit, because you've been in the business quite a while. So give
Yes,
us
I have.
don't give us the 30-year version. Give us 30 seconds.
Yeah. Okay. Well, yeah, I've been actually a lender for 34 years. Came into the industry after 10 years of being a real estate broker. So I kind of really understand what's going on. Deep dive over the past 34 years. And it's been crazy all along, you know.
Yeah.
We
Yeah.
go from stagflation to our inflation of the day. And stagflation is something that's been coming up lately.
Right.
As That's why we're looking at. Truth is, that's why we're looking at cuts.
Right.
Fed ain't just doing this to be nice to us. They're actually concerned about. We don't want to roll back into the 1980s. That was
Right.
horrible. Where you got inflation and people not working simultaneously. It's pretty ugly.
Yeah, obviously the reports were that they raised rates faster than they've ever done in history. So people are thinking now that they're going to lower rates almost as fast. So they started out with quite a cut, and of course everybody was all excited. But I think that was a little bit priced in. We didn't see a big reduction in the mortgage rates. But why don't you explain a little bit how that correlates so that people can understand?
Yeah, well, we're not. The Fed doesn't really control mortgage rates. Those are hashed out on the bond market. You got some of the biggest players in Wall Street. These guys are buying millions of dollars worth of mortgages at any given time, and they're competing directly with the government, who is also selling bonds over there in the same marketplace. So we it is relevant in that just like hot dogs and chicken or beef and chicken, if one of them changes, the other one has to come along. You know,
Right.
you can't be out of the market. So that's the effect. But as far as like the Fed says it's going down a half, and now all of a sudden your rate's going down a half, it doesn't work that way at all. And you were right. What was happening was they've been anticipating this for about a year and a half, actually.
Right.
You know, they've been talking about a year and a half that, yeah, the Fed's going to cut, the Fed's going to cut. Oh, guess not. Oh, guess not. So they finally showed up and cut a half, which was actually the best case scenario, which
Yeah.
was surprising. I figured a quarter, to tell you the truth. I didn't think they were going to be that aggressive. But unfortunately, that was already uh, sized into the to the mortgage rate. So there was no drastic momentary change. It ain't like all of a sudden our rate went down a half. Now these guys anticipated the half. If we got the quarter, they probably would have went up, to tell you the truth, because
Yeah.
like I say, at that point they said, "Oh God, we miscalculated. We got to make an adjustment." In fact, they did go up a little bit. They've kind of they kind of
Right.
they've kind of balanced out at this point. But yeah, there was a couple of days there were rocky where rates actually went up after the rate cut, while they were trying to hash it all out. At this point, it's really going to be about the numbers. I don't think that the Fed's just going to jump in there and start hacking away like a lot of people are thinking,
Right.
and like they have been thinking for the last year and a half. Um, the reason they got involved, we had $1 million, not $1 million, million person jobs, a million jobs that weren't there. And
Right.
that was
Right.
done in an audit. So when that popped up, all of a sudden, Fed realized all the numbers that they were working on had a million jobs that weren't ever there.
Correct.
And so then they started thinking seriously, oh my God, because if they overstep and we end up in stagflation, like I say, that's the worst thing ever. That's where everybody's laid off, and you're looking at double-digit inflation. That's the kind of thing we saw in the 80s. It was horrible. We never want to repeat it. So they were pretty much forced to, do something. At this point, what's going to happen is they're going to start reviewing all the data. And the truth is, there's been nothing exciting going on in data since the cut.
Right.
The PCE yesterday, everything's coming in pretty much where it's supposed to be. And I don't necessarily think that like I said, they're just going to start hacking away.
Right.
Jobs is a very important thing, and that's going to come up here shortly. First Friday of every month is when they bring out those numbers. So they're going to be watching those like a hawk, and the inflation numbers.
Right.
Consumer sentiment, these kind of things is what drives it. If those are coming in, lower than expected, we're going to see some more cuts. If they come in higher than expected, or just we're expected, we may not see any follow up on this. We'll just have to see. I wouldn't,
Well,
maybe next year we'll see some action, but like I say, I don't think it's going to be by the end of the year like some of these folks are talking about.
Yeah. Well, my guess is as good as any. But as being in real estate for about 30 years, 32 years actually, this spring when they didn't make any cuts, they were threatening to, and they didn't make any. I said, well, then they're going to make one good one in September, and then see how that flies. They didn't help the real estate market this spring. It's been incredibly tight inventory, and a little bit tight for people to get mortgages. It happens, but with the inventory so low, there's just not the same amount of deal flow that's going on. So it's been challenging in the real estate market because of that.
Yeah,
with this loosening up, there's a little bit of light. And I think that people feel more comfortable. And of course, I don't think, and I don't tell people to, wait for the rate to drop and, you'll do all right in the spring. I don't see that happening either. I guess they're going to do one more small one at the end of the year, but then let it float right through the next spring to see how the real estate does, because we also know that real estate creates a lot of jobs. There's supposed to be 27 people employed when a house sells. Yeah. So I think that would spark up the economy if we could get a little bit more inventory going on and a little bit more action going on in real estate would help all the way around. So a little bit of easing into next spring, but I don't think it's going to be as fast as they went up. It's not going to come down just as fast. I don't think they want to go back down that low, but they've got some work ahead of them. But
lower those rates, we have to bring sellers into
right.
the market as well as buyers, because if you just bring in more buyers on the market as it is, that's just going to exacerbate everything that we got going right now, but if rates do decrease, that could encourage some sellers with low rates to go ahead and make the move. Right now they're looking at 3-4 rate, and the prospects of paying 6.25 doesn't really
might as well bring up the official rates, and you can explain these to a little bit of us. The 30-year fixed rate, 15-year fixed, and 30-year jumbo. What's a jumbo in your area?
Boy, it's like they just changed it. It's, I think, 830 something over 832,000. So it's like I say, you really got to have quite a loan. That puts you in a whole different turf. 832,000 on down. Right. You're up here in the regular rates.
Right. And then the other ones here, we got an adjustable rate, the FHA and VA, of course, if you're in the Veterans Association.
And those are subsidized a bit by the government, so they're better than the conventional as far as the rate goes.
Very good. So what's the process of determining what's the best rate for your customers? About how often are you consulting with new buyers and sellers that about their rates and what's going on? What's the process of getting in and getting pre-qualified?
Well, they they apply.
Mhm.
The main concerns are debt, loan to value, credit score, um, and property type. So if
Right.
you're buying as an investor or commercial, it's a whole different ball game. If you're buying as a primary, you get the benefit of that. Now, we look over those. If your credit's pretty good and your debt's under control, I can get you in with as little as 3% down. So, and we have subsidies out there. You know, there's actually people out here in Metro Detroit where you can get up to $25,000 help for first-time homebuyers and things of that nature. So that seems to be the hot one today. The first-time homebuyers are making the moves. Many more of those in the mix today than there has been traditionally. Because like I say, the folks with the 3 or 4% rates are kind of
Mhm.
sitting on it. You know, they're not anxious to jump out there and deal with a rate like this. And it does make a major difference, especially if you're moving up.
Right.
You know, if you're moving up and you're paying $2,000, $2,500 a month, and then you say, well, I'm going to buy a little bit bigger house, and all of a sudden they tell you, well, it's going to be $3,000 a month instead, or $3,500. It's like, oh my God, you know, maybe I'll just sit here and clean the place up a little bit, you know, do a couple renovations and stay.
Right.
But yeah, it's pretty simple these days, and most of it's done online, which is incredible. You know, our technology, you don't have to get dressed up, come to the office anymore. You just
Yeah.
jump online, fill out a form. I do everything on my side electronically. You drop a couple of documents in the feeder, and off you go and buy a house. Like I say, as simple as it's ever been, you know, since I've been in this business.
Yeah. And AI is right around the corner trying to help you out.
Right.
How much credit counseling, or do you have to? Do you get involved in helping people fix up their credit before they
I do.
pull the trigger for a loan?
Yeah, I do.
And how long do you recommend that process go on for?
Well, that depends.
Or how soon? How soon do you start that process before they want to buy for the spring? Let's say.
I'd say you should probably be looking into it at least 90 days ahead if you believe that you have a problem that needs a solution. Now, if you feel like, you know, you're well qualified, you know, you don't need a lot of time ahead of time. But if you've heard that your score is low, or you know that you got a couple of dings, good time would be, like I say, good 90 days ahead of time. I have proprietary technology where we can kind of reverse engineer that score of yours and figure out where the problem is. A lot of time it's debt. Debt drags on a score pretty heavily. So if I got a bunch of credit cards and they're maxed out, it's going to take a big bite out of my score. Oftentimes that's as easy as the solution is. I just did one. I got one going right now. Guy come in and couldn't make the program. We wanted to get him on a down payment assistance program. The one I was looking to line him up with has a minimum score of 640. He wasn't there. It was a simple matter of paying down one credit card, boom. All of a sudden he's 670, just like that, from 620 to 670. So it's pretty easy fixes. We're not really killing people over collections anymore. At one time, that was amazing. Oh my God, you know, I got a medical collection. I'm done. I'm toast. We don't even consider medical collections in the mix at all these days. It's just completely off the sheet. One other thing I want to tell people is do not run out and pay those darn collections. For some reason, everybody's still got that in their mind. Oh, I got to run out and pay these collections. But though paying those collections will actually shoot you in the foot. So you don't want to pay them.
Right.
We deal with them in other ways these days. If you need to pay them, let me tell you that that's necessary. But it happens very, very, very slightly ever. And like I say, most of the time what happens is people just set themselves back. They don't move forward doing that. And so you need to talk to somebody that knows what they're doing.
Right.
A lot of these guys want to jump on Credit Karma and those kind of things, and they just make an absolute mess out of it.
Right, right. When the proper consultation will get you farther down the road faster.
Right.
Than trying to do that. So that's a good point. To 90 days, but it's really never too soon to get your credit in order. Is there a sweet spot? You were saying 670. Of course, higher is better, but is there a sweet spot where you get the most bang for your buck in your credit score and stuff? If you're looking at that, and how far off, if you're going to Credit Karma to check or track your credit score with your credit card sending. They send my score every month that, it went up 2 points, it went down 5 points, and I'm like, whatever. But what's the sweet spot for
well, Credit Karma, they don't even use the same engine we do. So
right.
Yeah, they have their own. That's why it's free. Unfortunately, I don't even pay any attention to it. People say, well, I got Credit Karma. I don't even want to hear the score because it ain't going to be anywhere near what I got. It could be high, way low. The odds of it being right on, you got about a 1% chance that it's even in the ballpark. So ignore that stuff and talk to some professional.
Yeah, that's what I always counsel people. And I say, go to the source. It's the same thing with an appraisal. When we're talking about the house, people are like, it'll appraise. Or when I counsel someone before they put it on, I say, let's get an appraisal before we list the house, because if this guy works with a bank or closely with banks, he's going to know exactly how it's going to lay out inside the market. So that's always good to talk to a professional before you start that process and know where somebody's going to get approved for the loan. So the same thing with their going in looking for the credit side. You talk to a professional, you're going to know where you're going to land and what you're going to get approved for.
Yeah, you won't be disappointed that way. Get your heart set on a house and then go talk to a professional and find out you're not qualified to buy it. That happens a lot. I don't know why people avoid us, but it's kind of strange. You don't avoid a doctor when you're sick, but as far as a lender, they just try to avoid us at all costs, it seems. That I'm the last guy they want to talk to. And I got to tell you, well, you got terminal cancer, guy. We can't do anything for you.
Right.
You need to get a hold of us early in the game.
Well, that's the oldest saying is an ounce of prevention is worth a pound of cure. And if you just started early and got yourself set up, you'd know, which path to take to get you where you want to go, and or just align your sights with what your income is going to get you in the marketplace.
As far as the score goes, 740 is like the end all. If you got 740 or above, there's going to be no adjustments. When you start coming down to like 680, 620, 640, there's always going to be adjustment. Anything under 740, you're going to find some kind of rate adjustment. So you're going to pay a little more, and the further it goes down, the more and more you're going to pay. So sometimes you might be better off, knocking down a credit card a couple $1,000, because what you'll save over 30 years on a lower rate will be 10 times that,
Right. And then, so just as for this fall, where are you seeing, is there anything you think is going to jump out and change anything, or if you think they're just going to stick around these rates right here for the fall buyers and sellers?
Yeah, I think they're going to be pretty steady. From what I'm seeing, I keep a pretty tight eye on this thing. I have a couple of subscriptions. I got a day-by-day pulse, and there was a lot of chatter going on before this cut, but I'm not hearing much noise anymore. So nobody really is expecting to see. This ain't the kind of stuff you're going to see every month for the, half a point a month. It ain't going to fly like that. Probably won't see anything till the end of the year, and maybe something in December. A quarter, half in December, but I would not expect anything before that. And so far, I've been right on. So I've been telling people all along they're not going to cut. Yeah, but they said they're not going to cut. Oh, but They're not going to cut. You know,
Yeah.
you got to look at the data. It's either there or it's not. If it's there, they're going to cut. If not, those bankers, like I say, they're very cold. They're looking at numbers, and that's the only thing that's going to move. You know.
I know when you said at the beginning of the show that when the jobs data came back as adjusted nearly 1 million off, I knew that changed the data outlook that they were working with. So they had to make a big change to catch up to where they should have been. But yeah, they're gonna analyze things pretty tightly for now and coming into the end of the year. So we'll see. I don't want to get political, but do you think that the election is going to make any bit of difference in this situation?
Probably not.
Yeah. I mean, it happens every 4 years and people are fighting over what's going on. And so, we should be kind of used to this by now. I don't think that this, people, a lot of screaming and yelling, but I don't think that that's going to swing the real
it
estate
takes a
market
while
too
for
much.
them to do anything, even regardless who wins or who doesn't win. Nothing, it's January before they even move in. Nothing's really going to happen until we see what those folks are actually going to do. What kind of moves are they? Are they going to get into the housing market like they claim and make all these adjustments? Are those adjustments going to work? I'm not that sold on the idea of giving everybody $25,000.
Yeah.
Like I say, right now we got too many buyers in the market, not enough sellers, so I don't know how that's going to help us out. We're just going to have to wait and see how things work out.
Yeah, exactly. So I have your LinkedIn address there. If anybody wants to reach out to you through there, is there a better way or anything else you want to leave with people before we send it off?
No, I guess that's a good one. Or you can call me direct. Am I allowed to give my phone number on here?
Of course, yeah.
Okay. You can call me directly at 586-484-5058. I'd be glad to run by everything with you. No cost, no obligation, no pressure. Just call me and ask me the questions. I'll answer them for you.
Did I get that right? 586-484-5058.
That's it.
All right, excellent. Anything else you're working on besides the mortgage business? Anything personal for the end of the year? Any projects, or do you get invited to a lot of charities? Or I know that a lot of mortgage guys run around to different golf outings this time of year. Any projects that you're working on personally that you want to promote?
Nope, not especially.
Okay.
I got a business, so BD&G Social Connection. We are doing a charitable thing here next month. We're going to bring in some toys for the kids.
Excellent.
We pick a charity every year, and we line it up, and then we bring people in. They come on in, bring a gift, and we'll buy you your first drink, kind of thing. So
wonderful. Excellent. Well, thank you for taking the time to meet with me today and updating us, of course, on the mortgage market. And then, of course, there's Burney's information here, and we'll put it into the comments there for everybody that's watching the replay. So thanks again, Burney, and we'll have you back again soon.
Thanks, Tim. I appreciate bringing me in.
Have a great weekend, everybody. Thank you.
Bye.